All right. Good evening, everybody. You're welcome to class again. So we'll continue our discussion on the part D of the syllabus. Yesterday we looked at sources of finance. Today we're going to continue by looking at the cost of capital. Cost of capital. Cost of capital. Now, if you look at the syllabus, we are required to evaluate the cost of equity, including application of the dividend growth model and explanation and discussion of systematic and non-systematic risks, the relationship between portfolio theory and the capital asset pricing model, the application of CAPM, its assumptions, advantages and disadvantages. And we are asked to evaluate the cost of debt relating to the following: irredeemable debt, redeemable debt, convertible debt, preference shares, and bank debts. And we are to calculate the overall cost of capital using weighted average cost of capital, that is WACC. That is WACC. So, talking about cost of capital, what is cost of capital? What is cost of capital? Cost of capital is a way of introduction to say it represents compensation. Cost of capital represents compensations required by suppliers of funds from their investments. Now, when you give out your money, when you invest in an organization, you purchase shares in an organization. Yes, you're actually purchasing shares, but the organization is making use of your money as investment, as source of finance. So as you give out your fund to buy shares, you are expecting a return known as what? Dividend. So it is expected that the organization make use of that, your investment, to generate profit. So in return, they'll be able to pay you back dividend. So cost of capital represents the compensation required by the suppliers of funds from their investments. So it is the rates of return that the suppliers of capital, who are these suppliers of capital? The bondholders and shareholders or owners require as compensation for their contribution of capital. As you give out your resources, as you give out your finance as source of funds to organization, you expect a return. That return is a cost of capital. The return can be a fixed return. The return can be open, whereby there is no fixed, because when organization gets some loans, the loans can be 5% interest, the loan can be 10% interest, depending on the agreement. So there are some cost of capital that are clearly fixed, that are clearly defined, while some are not clearly defined. So a firm creates value when it provides a return greater than its cost of capital. So, for example, we've looked at issues of NPV, internal rate of return, and we're solving those solving questions on those topics. We are seeing points where we're using, let's say, 10% as discounting factor, 5% as discounting factor, which in some questions they'll tell you that they are the cost of capital. So a firm will create value when it provides a return greater than its cost of capital. So cost of capital is determined by the forces of the market, and it represents the degree of perceived risk by investors. So in other way, we can say cost of capital is regarded as opportunity cost. Cost of capital is regarded as opportunity cost. Cost of capital is regarded as opportunity cost because it represents the return that investors forgo by investing in one project instead of investing in the next best alternative. Because when you have your resources, you have quite a number of options to invest in. So when you invest, when you make a decision to invest in project A, it means you are foregoing the return that you should have obtained when you invest in project B. So for example, if shareholders expect a 12% return on their funds, any project the firm undertakes must earn at least 12%. If the shareholders expect 12%, any project you are using your shareholders fund to finance, you should earn a return of 12%. So if the project earn less, the firm has effectively lost the opportunity to generate the expected return elsewhere. So that is why in some palace, you can refer to cost of capital as opportunity cost of finance, because it is the minimum return that investors require on their investment. Otherwise, they will transfer some or all their investment to another place or company where the return will be much more favorable to them. So looking at the slide, I said the cost of capital is a key concept in finance and economics that refers to the cost of funds used for financing a business. It is essentially the rate of return that a company must earn on its investment to maintain its market value and attract funds. So the cost of capital is crucial for corporate decision making, as it acts as a benchmark for evaluating new projects and investments. So cost of capital for investors. Now, to an investor, the definition of cost of capital is the return the investor is expecting. So the cost of capital for investors is the return they require from their investment. So company must generate enough returns from their capital investment to meet the returns required by their shareholders and debt holders. Hence, the cost of capital for investors sets the cost of capital for companies. So your expectation as an investor will make the organization judiciously make use of your fund, because they need to pay you back dividend. They need to pay you back interest on the loan that you gave to them. So each company has a cost of equity, which is the return required by its shareholders through dividends or share price appreciation. So there is a cost associated with each debt financing item, which is the yield required by lenders or bond investors. For companies with preference shares, there is also a cost associated with preference share capital. So what we're just trying to say is that for equity, there is a cost of equity, there is cost of debt, there is cost of preference share, there is cost of redeemable debenture. So all these are all what the syllabus want us to examine. So also, the cost of capital for a company is the return it must earn on its investment to afford to pay its investors the required returns. So in theory, the cost of capital for investors and companies should be same. But however, they differ due to varying tax position of investors and companies. Now, to a company will enjoy what we call tax savings on interest. But to an investor, the individual will not enjoy tax savings. So the cost of capital for investors is measured as a pre-tax cost. Yes, it means you won't enjoy tax saving as an investor when there is a corporation tax. It is the organization that will enjoy the tax savings, the tax shield. So the cost of capital for companies recognize that interest costs are an allowable expense for tax purposes. Yes, that is where you do 1 minus T to get the tax savings. And the cost of debt capital to a company should allow for tax relief that companies receive on interest payments, reducing their tax payments. So the cost of debt capital for companies is measured as an after-tax cost. So the weighted average cost of capital is the average cost of all the capital sources a company uses. For example, company XYZ can have a capital structure consisting of debt and equity. That is, what are the components of its capital? It's borrowing, it's also issuing out shares for the public to subscribe to. So it means when you look at the proportion of its capital structure, it consists of debt and equity. Some organizations are just equity finance, only financed by equity. And when an organization is financed by equity, it means they are engaging themselves in high cost of capital, because equity is an expensive source of capital, because shareholders will require high return as against debt. So debt is a cheap source of finance. Loan is a cheap source of finance compared to equity. Compared to equity. As we go ahead in our studies, we'll see that even as you move to the next phase, SFM is a concept that you keep talking about. So talking about cost of capital, the importance of cost of capital. Cost of capital is is an important is an important area in financial management and is referred to as the minimum rate, break-even rate. So the cost of capital as an operational criterion is related to the firm's objective of wealth maximization. So the importance of cost of capital, one, is that it aids in investment evaluation and appraisal. It aids in investment evaluation and appraisal. What do I mean by this? Because the primary objective of determining the cost of capital is to evaluate a project. So various methods is used in investment decision, and they require the cost of capital as the cut-off rate. So the cost of capital is used as a discounting rate of determining present value of cash flows under discounted cash flow method of such as net present value, internal rate of return, adjusted present value, modified internal rate of return, profitability index, and benefit cost ratio likewise. So a project is accepted if it generates a positive NPV or its internal rate of return is higher than its cost of capital. So we can say cost of capital provides a rational mechanism for making an optimum investment decision. So this is one of the advantage of cost of capital for investment evaluation and appraisal, and it can is a good measure of determining the optimal mix of capital. Yes, that is the capital structure, debt versus equity. What is the proportion of debt to equity? So the cost of capital influences the proportion of debt and equity in the capital structure of a firm. So the optimal capital structure of a firm can maximize the shareholders' wealth, because an optimal capital structure is expected to follow the objective of minimization of overall cost of capital of a firm. So it is expected that using cost of capital, we should have a balanced mix of debt and equity. So these are some of the importance of cost of capital. Of cost of capital. Let me be guided by my slide. So we have elements of the cost of capital. The cost of capital is a return that investors expect to be paid for putting funds into the company. So in other words, it is the cost incurred by a company for raising money to finance its activities. Please take note of that. The costs an organization incur in sourcing for money, the cost you incur in getting debt, the costs you incur in getting shares, shareholders to invest in your organization. What do you pay them in return? That is the cost of capital. So, in other words, it is the cost incurred by a company for raising money to finance its activities. The elements of cost of capital are the risk-free rate of return, that is return required from an investment, which is completely free from risks. And what are those investments? They are government securities, otherwise known as gilt-edged securities. Also, we have the risk premium. This is return to compensate for financial risk. In business, we have what we call financial risk and business risk. Financial risk is the risk a business encounter when they introduce debt into their capital structure. But when a business is being run just solely based on equity, it is free from financial risk. But as you introduce debt into your capital structure, you face financial risk. And also we have the business risk. The business risk. The business risk is the risk that a business is exposed to based on the fact that they are engaged or they are in a particular line of business. So any firm, any business that is into a particular industry is expected to face certain types of risk. So that is business risk. So the risk premium is an element of the cost of capital likewise. So we have various forms or cost of equity that we're expected to look at. So we have cost of equity using dividend valuation model. Cost of equity. There are various ways you can determine your cost of equity. So one way the syllabus want us to evaluate is using dividend valuation model and using dividend growth model. So cost of equity using dividend valuation model, we are required to know certain things. In trying to determine your cost of equity using dividend valuation model, your dividend or your market price can be SDIV or CUMDIV. Your market price can be SDIV or CUMDIV. XDIV. You can have CUMDIV. CUMDIV. When your market price is SDIV, it means dividend for that period have been paid. It means the market price is excluding what? Dividend. But when the question is saying dividend is yet to be paid, it means that the market price is CUMDIV. So what do you need to do when the market price is CUMDIV? Because anytime you are solving, you have to solve with XDIV, excluding dividend. So when the question is telling you that dividend is yet to be paid, dividend will be paid in the next 2 months, what you need to do is to determine what your market price is, what the market price is, and less the value of dividend. Less the value of dividend to get what? To get XDIV. To get XDIV. To get XDIV. So for us to determine cost of equity using dividend valuation model, we have a situation whereby you can have a growing dividend and you can have a constant dividend. So where you have a constant annual dividend, the dividend is fixed year in, year out. What do? We have a formula to adopt. So where a company is expected to pay a constant dividend in perpetuity, when we say in perpetuity, it means till infinity. There is no definite time that's that constant dividend will stop. So when a company is expected to pay a constant dividend in perpetuity, the cost of equity can be calculated using this formula, where KE is cost of equity and D is the current dividend and P is the market price excluding dividend. excluding dividend. Where the market price is including dividend, you remove the element of dividend from the existing market price to get the market price in form of what? X-div, in form of X-div, in form of X-div. So that is where you have a constant annual dividend, a constant annual dividend. You can have a scenario where you have growing dividend. Dividend is not constant, but growing. There is a formula for that. Now, let's look at this example regarding a constant dividend. Constant dividend. The example reads us that sorry, excuse me, please. Hello, sorry about that. I need to generate a link for someone. So, looking at this example, that I love FM PLC has an issue 1 naira shares with a market value of 2 naira 40 kobo per share. A constant dividend of 30 kobo per share has just been paid. What is the shareholders' required return? And therefore, the cost of equity to the company. The cost of equity to the company. Shareholders' required return. And therefore, that is the cost of equity. So now, looking at this question the dividend is what? A constant dividend is 30 kobo, right? And share has just 30 kobo per share, and the dividend have just been paid. It means what? The market value, is it cum div or s div now?
It's ex-div.
The market value is s div. So the cost of equity will be what? The cost of equity will be what? The dividend is what? 0.3, 30 kobo.
Yeah.
And the market price is what? The market price is what? 2.4. So the cost of equity will now be what?
12.5%.
Okay, that is 0. Multiply by 100. Multiply by 100. You have it as what? 12.5%. 12.5%. So this is where we have a constant dividend. But the question can change. The question might not be in this form. The question might not be in this form. The question might not be in this form. Let's see it in another way. Okay, let's see this question now. Let's see this question. That Temitayo PLC has 1 million ordinary shares of 1 naira each, currently quoted at 1 naira 20 kobo. The company's current dividend of 15 kobo was paid last week, and this dividend will remain constant to perpetuity. What is the cost of equity of Temitayo PLC? You should be able to solve this. Let me quickly attend to something. Check the question and see if you should be able to solve it. Let me create a link for a class. Or I should go back to the previous example. This is the formula. Write it out, please. Okay, still 12.5%.
12.5%. Yes.
Okay. Just a few minutes. Let me just create a link. Okay. Can you take down this question even as I try to create a link? Let's see another approach. Let's see another approach. Let's see another approach. Let's see another approach. Let's say Shegun PLC. Please write it down. Write it down. Shegun PLC. Shegun PLC has 1 million ordinary shares. 1 million ordinary shares. One million ordinary shares of 1 naira each. 1 million ordinary shares of 1 naira each. £1 each. Currently quoted. Currently quoted. Currently quoted at 1 naira 15 kobo. Currently quoted at 1 naira 15 kobo. Currently quoted at 1 naira 15 kobo. And the company's current dividend is 10 kobo. And the company's current dividend of 10 kobo, rather. And the company's current dividend of 10 kobo and the company's current dividend of 10 kobo is about to be paid. Is about to be paid. Is about to be paid. The dividend, that is comma, the dividend will remain constant to perpetuity. The dividend will remain constant to perpetuity. Will remain constant to perpetuity. Determine the cost of equity. Yes, determine the cost of equity. Now, let me come back to this question. Maybe some persons might not actually um, determine. So looking at this class exercise that I asked everybody to solve, maybe there are some persons that didn't get it. That Temitayo PLC has 1 million ordinary shares of 1 naira each, currently quoted at 1 naira 20 kobo. The company's current dividend of 15 kobo was paid last week. And this dividend will remain constant to perpetuity. So based on this formula, the dividend is what? The dividend is what?
18%. 10 kobo.
The dividend is
15 kobo.
the company's current dividend of 15 kobo. You understand?
Is it 15?
That is 0.15 was paid last week. Now, what is the SDIV market price?
1 naira 20 kobo.
The SDIV market price
1.2.
is 1.2.
1 naira 20.
Yes, 1.2. So when you simplify this, you should have what?
18%. 12.5%.
12.5%. So this is the cost of equity. This is the cost of equity of the entire. Now, coming to these to the other question I dictated. Let me put it down too. Let me put it down. Example. Can somebody read, please? Can you just read it to my hearing? I know I use Shegun PLC, right?
Yes, sir.
Shegun PLC has
1 million ordinary share
1 million ordinary shares.
of 1 naira each.
1 million ordinary shares of 1 naira each. Currently,
Current
is currently quoted at
1 naira 15 kobo.
1 naira 15 kobo,
And the company current dividend
and the company and the
Okay.
company's the company's and the company's current dividend
of
of
10 kobo
10 kobo
is about to be paid.
is about to be paid. Is about to be paid. The dividend
Remain constant to perpetuity.
will remain constant to perpetuity. Perpetuity. And what did I say? To determine
Determine the cost of equity.
the costs of equity. Now, based on the earlier explanation now, in this case, the dividend is yet to be paid. What will happen here?
That means
We make it as div.
I will determine SDIV by surprising market price minus dividend.
Very good. So you have it this way. Solution. The formula is what? The formula is this. The formula is this. Now, in this case, the market price is cum div. Is cum div. That is cum div price. Cum div price. And this is equal to, what is the cum div price? Cum div price is what?
1 naira 5 kobo.
1.15 cum div price. Now we need to less dividend because we need ex div price. That is what we need. Less dividend. Why are we lessing the dividend? Is yet to be paid. Is yet to be paid. That is why we are deducting the dividend. Anytime we are solving, you have to use X. Yes, Bridget.
Sir, good evening, sir. Please, sir, I can't see the slide. I can't see the board. Thank you, sir.
Is there everybody that can see the slide, please?
No.
we can see the slide.
No.
We can see. I can see.
Maybe log out and log in again.
So we have cum div
Oh,
price.
sir, thank you.
Cum div price of 1 naira 15 kobo. Now we need ex div price. Why are we deducting the dividend? Because it's yet to be paid. So we need to deduct the dividend. The dividend is what? 10 kobo, 0 points. So for you to get the ex div price now, ex div will now be what?
1.05.
Ex div will be 1.05, right?
Yes.
1.05. So this is the SDIV market value. Now with this now, you can determine your cost of equity. The dividend is what?
It's 1.25.
Now
No,
the
10 kobo.
market value is what? SDIV.
1.05.
1.05.
So your cost of equity will now be what?
9%, 9.5%.
9.5%. So this is where the dividend is constant. Where the dividend is not growing. Where the dividend is not growing. So you apply this approach, this formula. Apply this formula. So where we have a growing dividend, where the dividend is growing, what will be the scenario? So with dividend growing at a constant rate, we're going to say, because shareholders will expect their dividend to keep increasing year by year. If you keep getting same dividend every year, you will not be happy. Yeah, so you expect that there is an increase year in, year out. So the fundamental theory of share value states that the market price of a share is the present value of the discounted future cash flows of revenues that is from the share. So it's expected that if dividend will keep growing, what will you do? You apply this formula. With dividend growing at a constant rate, where a company is expected to pay dividend at a constant growth rate in perpetuity, the cost of equity can be calculated as what? The dividend growth model is used, and we have it as cost of equity equal to what? Dividend into the bracket of 1 plus G divided by what? The market price plus G. So DO here is the current dividend. The G here is the constant growth rate, and the P is what? The market price. Then plus the growth rate. So when you have this scenario, how are you going to solve questions? Please write this formula down. Where you have a constant, a growing dividend, growing at a constant rate. Dividend growing at a constant rate. So you use this formula. Cost of equity is equal to D into the bracket of 1 plus G divided by PO plus G. Depending, if you go to some literatures, maybe your study pack, this PO might be MV, market value. Take notes, please. Yes. I went through the study pack today, yes, this afternoon, to just see what is there. So in some literatures, the PO can be MV. Just know how to interpret it. So don't get it twisted. In financial management, as we keep going onward, you'll be seeing various forms of formulas. So just stick to one. Yes, don't go to this book. You see the way they put it, you get confused. You go to another book, you see the way they put it, you get confused over the whole thing. Stick to one approach. Yes, because by the time you go to different books, many books, you keep seeing the way the authors put them. Yes, adopt one approach and follow it. You'll get same results. So we have this formula for a dividend that is growing, a constant rate. Now, let's look at an example. We have this example here that a company is expected to pay a constant dividend of 40 kobo per share. The current SD market price is what? Is 3 naira per share. What is the cost of equity? That is A. B. What is the cost of equity if anticipated growth in dividend is what? Is 10%. So everybody should be able to solve this A. Can you solve this A? This is without growth now.
Yes, sir.
Let's the cost of equity will be what?
13.3%.
Okay. Any other person with same results?
Same, 13.3%.
Fine. Now, looking at B, what is the cost of equity if anticipated growth in dividend is 10%? If anticipated growth in dividend is what? 10%. Now, it will be in this form. So we'll have it. The dividend is what? From the question.
0.40.
0.40. It's now very tiny. So we have it as 0.4. 0.4. The growth rate is what?
10%.
10% is same as what? 0.1.
0.10.
The market value is what?
3 naira.
3. The growth rate is what?
10%. 0.10.
1.
So simplify now. What will be your results?
2.5 divided by 2.5. 0.5 plus 1. 0.246. Approximately 0.25. That's one. I got 0.6. I got 0.246. Approximately 0.25. times 2.4.
Yes. In percentage now, you have it as what?
25%.
Yes.
25.
But who is not getting it?
25%, yeah.
So who is not getting it?
Sir, I got this one, but what do you mean, sir?
Sorry, I can't get you, Madam Faith.
Good evening, sir. So, sir, what I'm trying to say that the A, because I just, I didn't get the first that growth formula. I've not solved my A. I don't know if you can take it. The
The A
solving
does,
of that part A.
the A is just
The A of this. Um,
the A is just your dividend divided by what's your market price multiplied by 100. That is what you need for A. Yes, that is what you need for A. That is what your dividend is what 0.4 divided by what 3 multiplied by 100. You have the results you need. You have the results you need. So can you solve this, please? Or we'll solve this. Okay, let me see. Okay, yeah. So can you solve this? Sonia PLC has 1 million ordinary shares of 1 naira each, currently quoted at 1 naira 30 kobo. The company's current dividend of 20 kobo per share is about to be paid. This dividend will grow at the rate of 5% to perpetuity. What is the company cost of capital? Yeah, in this class, you don't know what we've been doing. Send me a message.
Three percent. I don't know.
You said
73%.
73%.
So,
Okay, let's get another confirmation from somebody else.
okay.
Okay,
Or 18% too.
you got what?
18%.
18%.
Yes.
I got 21%.
I got 15%.
Okay, be serious. Okay, I can see Mr. Don that you joined late. Yes, you have to take your time to watch the video. Faith, I can see your message. Just at the point where you are, just try and keep following. Keep following. Yes, we'll keep moving. Yes, so don't worry, you catch up. So
Please, I need to check the formula
I
for
got
the growth rate.
24%.
24%.
20%.
Okay. Oh,
20%.
that is interesting. So let's see. Let's see.
21%.
Okay,
Yes.
that is fine.
20%.
Okay, that is beautiful. Solution. In this question, dividend is yet to be paid, right?
Yes.
Cum div. Cum div.
Yes.
Cum div price. Cum div price is equal to what?
1.30 minus 3.20.
Less dividend. Less dividend. The value of dividend is what? That is expected to be paid.
0.2.
Ex div price is what?
1.1.
1.1.
Ex div will be equal to 1.1. Now, it is expected that dividend will keep growing. Dividend will keep growing. At what rates?
5%.
Yes.
5%.
5%. So the dividend, substituting into this formula, dividend is what? 0.20.
0.2.
The growth rate is what?
0.05.
2.05.
And the price will be what?
Market price.
1.30.
Simplify. Let's see.
24%.
24.
24%.
24%.
Yes.
So
20
who is not
like
getting 24?
I stop at what is it called? I saw that
I have another class exercise, but you solve that on your own. There is no. The question is, I will pass PLC. We have to pass.
Hello, Mr. Toku, please. I need a solution page to Sonia.
Baba.
Thank you, sir. I'm done. I'm done.
So this class exercise, you solve it again. Because that formula must be with you. That formula. Don't look at your book now to write the formula. Just write it. Write something. KE is equal to this, that. Or if you know you don't know it, still write it though. Still look at the formula and write. So the question read does that I will pass PLC has an issue 50 Kobo shares with a market value of 4 naira 20 Kobo per share. A dividend of 40 Kobo per share has just been paid. Dividends are growing at what? 6% per annum. What is the cost of equity? So the answer is what? So the answer is what now?
16.1%.
16.1%. So that is it. Who is not getting 16.1%? Who is not getting 16.1%?
So you can assume it as 16, Abby. Since
Very well, very well.
16.09. Okay.
I got 16.61%.
Yes. So that is it. That is the answer. Let's move forward. So the point is this: note, cum div price is equal to what? Ex div price plus dividend due. Cum div price is ex div price plus dividend due. So for you to get ex div, it will be what? It will be cum div minus dividend due. So it will be cum div minus dividend due for you to get ex div price. This is just a simple example that a share is quoted cum div at 4 naira 50 kobo. The dividend has been declared 0.5 is what we've been doing. Yes, is what we've been doing. So to get your ex div, it will be 4.5 minus 0.5. You have your ex div because this is cum div. So the difference between cum div and dividend declared will give you what? Ex div. Give you ex div. Now let's take it further. Now you can have a situation whereby you have to estimate growth rate. Where you have to estimate growth rate. There are two approaches to estimating growth rate. We have the historical approach, and we have the Gordon's growth model. Gordon's growth model. Now the historical approach is an approach whereby they will give you arrays of dividend for various years. So you have to determine the dividend growth using the base year and the current year, using the base year and the current year. Now, the growth rate can be estimated using either historical pattern or Gordon's growth model, depending on the information available in the question. So the historic or average pattern is expressed using this formula here. N to the power of 1 over n minus 1. You get your growth rate. dn is what? dn is dividend in the past. That is, if you have dividend in the question from 2020 to the date, it means the base year. If the base year is 2020, it means your dn will be 2020, the dividend for 2020. Now, what is your current year? If your current year is 2024, because we are not yet done with 2025, the current year, that is the last year given in the question, is 2024 dividend. That will be your what? Your dn to the power of 1 over n. Now, what is n? Take note. When you are giving dividend for each year, the approach is you deduct 1. For example, you're giving dividend for 2020, 2021, 2022, 2023, 2024. The approach is there is a concept that dividend will be paid at the end of the year. So it means that dividend for year 1 will be due at the end of the year, which is not current. It means that, let me just show an example. For example, we have this now, that dividend for each year is given. Year one, you have this 180,000. For year two, you have 210,000. For year three, 220,000. For year four, you have 245,000. For year five, you have 280,000. Now, the concept is, where dividends are given yearly, we should count the number of years and deduct 1 from n. You count the number of years. You have 1, 2, 3, 4, 5. Now, for you to solve this now, it means that the value of n will be what? The value of n will be what?
5
4. 5 minus 1, 4.
Yes, 5 minus 1, 4. Where you are giving the dividend year in, year out like this, in this order, it will be n minus 1. In some textbooks, in some literatures, they will just put n. They will not tell you that it's n minus 1. You begin to imagine, but you are saying 5, but they are putting 4. You are saying 3, but they are putting 2. That is the concept. I've gone through various literatures, and that is why I'm telling you this, that n is n minus 1. N minus 1. Yes. So it means when you are giving 6 years, it will be 6 months to get the value of n. Now, it can be in two forms. You can either use this, having the roots, you should arrive at the same result. So you can have this likewise, where g is equal to n minus 1. Take note, this is it, where g is equal to n minus 1. When you are using this approach now, n minus 1, that is the latest dividend. The latest dividend, that is the current dividend, divided by the base year dividend. So when you are asked to determine the growth rate, it will be you using either this formula or this formula. So we have another one, which is the Gordon's approach. Well, let's see this. Let's see this example, that a company currently pays a dividend of 32 kobo. Currently pays dividend of 32 kobo. 5 years ago, the dividend was what? 0.20 kobo. Estimate the growth rate. Now, what will be the growth rate now? Using this approach, the growth rate will be what? The growth rate, DO is what? From the question.
0.20.
0.20, sorry.
Yes, DO is what?
0.32.
0.32. Why is it 0.32? See it. Current dividend. Current dividend. So we have it as what? 0.32. DN is what?
Okay.
0.20.
0.20. Now, what is N?
N is 5.
5.
N is 5. N is 5. Somebody is confused now because, I earlier explained, where you have the dividend given to you in this form,
Yes.
that is when you less 1. Take notes.
Sorry.
Take notes. Don't be confused. Yes. So, what will now be the growth rate?
Zero 0.32.
0.
0.9.
I got
Check it.
0.3.
0.32. Let's check it well again.
Okay, sir.
0.09.
Was
He's
that?
giving me negative.
Is that?
He's giving me negative minus 0.68. It was 0.32.
Divide by 0.2 to the power of
Power of 1.
1.09. Okay, minus 1. 0.09.
It's still giving me the 0.32.
Okay. So in your calculator, press 0.32 divide by 0.20.
I got 9
I
point,
got
Me
1.16.
9.8%.
9.9.
9.9%.
So approximately, you can just make it
10%.
10%. Madam Affinity,
So,
your calculator 0.32 divided by 0.20.
1.6 raised to power.
You just do what is 1 divided by 5? 0.2 raised to the power of 0.2.
Okay, sir. All right, I got it, sir.
Raised to the power of 0.2.
Thank you, sir.
Let's take it further now.
I've not still gotten this 9.9.
Go with 1/5 first. You get 0.2. Then treat the bracket, then raise power of 0.2. You will get it.
Oh, okay. Let me do that. Thank you. Got it. Thank you.
All right. So as we're not getting it here. Anybody in this class that is not getting it?
Sir, I just want to ask, are we going to multiply by 100?
Yes.
Yes.
You get 10%, yes.
Thank you, sir.
So what I have here is 9.8.
Yes, still approximately you have it as 10%.
Okay.
So we have this example that the dividend of Temi PLC over the last 5 years are given below. Year 1, 180, year 2, 210, year 3, 220, year 4, 245,000, and year 5, 280,000. Temis PLC's current SD market price is 4 naira, and it has in issue 1 million ordinary shares. 1 million ordinary shares. Temis PLC current SD market price is 4. So what will happen here now? We go with this formula here. We go with this formula here. So we have how many years?
5 years.
5 years.
The latest dividend, that is the current dividend, is what?
2. Need to see it. Okay, 280.
That's 80,000.
280,000. Now, the base year dividend is what?
180,000.
180,000. Base year dividend is 180,000. Sorry, everything is in roots. That is the 280. When you're writing it, 280 all over 180. Everything is in the roots place. It's because I didn't get an appropriate
Oh,
symbol.
okay.
Yeah, so please, when you say 280 divide, everything is in the roots, please. I didn't get an appropriate symbol to represent that. So when you simplify, what will be the growth rate? I think -1 here. So you have it as what? So this will now be 4. Take notes. This will be 4. So once you divide first, 280 divided by 180, then what is the root? The fourth root.
So 4 root.
When you do that, let me see. You should have G will be equal to you have something like this. So you should have when you divide, you should have 1.556.
556.
1.56.
556.
All right. So minus when you solve for that first, then the results -1. What will you have?
3.989.
3.990.
Okay, 3.99. You can leave it at that.
2.99.
$3.990.
Yes.
All right. Let me see.
I have 11.67.
Yeah, I just punched my calculator. I have 1.1168. Then if I minus 1, I will have 11 points.
11.6.
So I did 4 roots.
4 roots.
1.556, and
Yes.
give me 4 point something, then minus 4. I mean minus 1. Give me 3.989. So you can.
No, you are not pressing it well. You are not
That's
pressing
what
it
I
well.
also thought too.
You are not pressing it well.
So, Tokwe, will you do square root of 1.556 minus 1 before you? How will you treat the 4? Because I'm doing 4 roots 1.556. 4 root 5, 4 and 1.556 giving me 4.990 minus 1, 3.990.
It's 4 roots. You press on my own calculator. I'm pressing 4 second function.
Okay, I got 98.96%.
So how do you know second function?
It depends on your calculator. On my own calculator, as I press 4, you see shift, then the roots. I have various symbols in my calculator. Then I will now press 1.556. Inside the roots, I have I have 1.11686. So press your calculator well.
You said I'll press 4, shift, root, then 1.556, right?
Yes.
Please, sir, can you explain that procedure, sir?
It depends on your calculator. The Casio calculator I'm using, maybe I should snap and send to you on WhatsApp.
It's happy I'm using too, sir.
So you press 4. 4. When you press 4, shift, which is the second function, you see a symbol.
Yes.
A symbol.
Root.
Root with like a full stop or square inside the handle. Then you press. Then you have inside the root, you have 1.556. Once we press equal to 1.116869415. That is what I'm getting here.
I'm
Then you
getting
minus 1. Who else is getting what we have on the screen?
I got it.
How is it different from yours?
Another option, 1.556 raised to power 1/4 minus 1.
And you can do it that way too. Let's
Yes.
see. Let's
In fact, I followed your directives, but I got 4.9 something.
please use this approach
Depend
now.
on your
That
calculator.
is what I'm getting to.
Please try this one. Let's see now. No, you shouldn't.
Just do 1/4, which is 0.525.
If you press shift, you press that thing that we used to use to do raise to the power of. That's the second function of that. Then you put 1.556 inside to give you the thing.
Sir, how we got 1.556, sir?
That one is 280 divided by 180, sir.
Okay.
I got it.
Likewise, me too. That raised to power.
Sir,
Thank you, Sister Shima.
I got it now.
sir, are you still going to multiply with 100?
Very well.
All right, sir.
So the result will be what?
0.116.
Where you get something, somebody's
11%.
1.67.
Right, it's 0.1168.
89.
It's immaterial.
69, yes.
89.
11.69.
11.6.
Approximately.
so the growth rate is what?
11.7%.
11.7%. Approximately should be
Yes.
12%.
12%. Yeah.
With this growth rate, can we determine the cost of equity? Can we determine the cost of equity? Haven't derived this. The growth rate is this. In the question, that's what? The SDIV market price is 4 naira, right? Is 4 naira. The SDIV market price is 4 naira. And it has an issue, 1 million ordinary shares. So it means overall, what will be the market price, the total market price of this 1 million ordinary share?
4 million.
Very good, 4 million. Because 1 The value of 1 is 4 naira. So 4 multiplied by this, you have what? You
4
have
million.
4 million. 1 million. So now, your current dividend is what?
280,000.
280,000. Fine. And your growth rate is what? 12%.
12%.
So can you use this formula, the growth? Where is it now? The growth rate formula. This formula now. Let's go there. Yes, this one to determine the cost of equity. With those variables you have now, can you now determine the cost of equity? If this is 280, and this is what? It's 4 million. The growth rate is what as determined?
12%.
12%.
Plus this is what? 0.12. The cost of equity will now be what?
19.8%.
19.8%. 19.8%. So who is getting 19.8% again?
Yes, sir. Yes, sir. 19%.
Correct, sir.
Yes, sir. 19.8.
19. So this is a question now. That it is now the year 2024, and VPLC has paid out the following dividend in the past years. These are the past years. Estimate the average rate of growth of dividend per annum. Can we solve? So what is the answer now?
.2%.
4.2%. Who is getting same result, please?
Same.
4.2.
Oh, that is fine. That is fine.
1.173.
So
4.2.
we have another approach to determine the growth rates, which is the Gordon's growth model. The Gordon's growth model. Sometimes it can be referred to as reinvestment of earnings model. Reinvestment of earnings model. reinvestment of earnings model. So this model is based on the assumption that the higher the company's level of retention, the higher the company's level of retention, the greater is the potential growth rate. What do I mean by retention? Retain earnings. The more you retain funds rather than sharing it as dividend, the better the growth rate you experience. Because as you retain funds and you plow it back into the business, you use it for business expansion. In the long run, the profit of the business will increase, and in the long run, the shareholders will have better dividend to take home rather than collecting the whole profits made in a particular year as dividend and smiling. Because when you don't plow back anything into the business, in future, you will not have much dividend to go home with because you are not retaining anything. There is no retention, less retention into the business. So it is based on this principle that Gordon growth model is put forth. So the Gordon's growth model assumes that the higher the level of retention in a business, the higher the potential growth rate. So growth rate is calculated, as you can see, G is equal to R multiplied by B. R multiplied by B. What is R? R is return on investment or accounting rate of return. And what is B? B is retention rate. So there are various ways you can determine B depending on what the question is given to you. Yes, B can be earnings retention rate. B can be proportion of funds. B can be what? Profits retained. You know, in questions, they might have they might give different names to B, synonyms for it. So where you are not seeing earnings retention rate and you are seeing proportion of fund, that is B. Where you are not seeing proportion of fund, but you are seeing profit retained, that is B. And you can also determine B by when you have earnings, that is earnings in form of dividend, divide by dividend, divide by earnings rather, divide by earnings. You can, sorry, let me present it in another way. This earnings dividend, let me present it in another way. See. It can be earning per share minus dividend per share divided by earning per share. So some questions will not give you some of these values free of charge. So where you are not given free of charge and you are giving some of these variables, you need to use these variables to determine the value of B. To determine the value of B. So B is your retention rate. Your retention rate. And it can be your profit retained, the earnings retention rate, that is a percentage given to you in the question, or it can be return on investment, depending on what the question is pointing at. That is your retention rate. So you can have a question regarding this, or before then, using this table here. If you look at this table here, we have earnings for year 0, 100, dividend 100, for year 1, earnings 100, dividend 100. What this implies is that the whole profit made in year 0 was distributed as dividend. There is no any retention. In year 1, the whole profit made was distributed as what? Dividend. No retention. No retention. It means high dividend, no dividend growth, and no growth in market value. That is for company A. For company B, there is a policy, earnings 100, 40% distributed as dividend. Retention is reinvested at 10% per annum. So it means that when we have a profit of 100 and we retain what? We retain 60 and we give out 40 as dividend. This retained earnings, when we plow it back into the business, it will yield the value of what? Of 6. Because we are retaining it, we are investing it at the rate of what? 10%. So 10% of these retained earnings will result into an income of what? Of 6. So it means your earnings in year 2 will be 6 plus 100. You have 106. Now, when you retain a portion of 106 again at 63.5, there will be an interest on it. It means as you retain back your profit, the yield returns. And the more returns you have, the more dividend you keep having year in, year out. As you can see, in year 1, year 0, 40, in year 2, dividend increase with a little proportion anyway to 42.4%. In year 3, in year 2, it increased to 44.9%. Unlike company A, whereby we're just enjoying ourselves, all we earn, we share as dividend. All we earn, we share as dividend. All we earn, it means it is constant. We are not growing. Yes, we are not growing because everything we earn, we distribute as dividend. Now, looking at this example, now our PLC retains 40% of earnings each year and is able to reinvest so as to earn a return of 20% per annum. What is the expected growth rate in dividend? What is the expected growth rate in dividend? So in this question, G is equal to RB. What is R? What is R in this question? G using growth
Return on investment. That's 20%.
Yes. So R is what? G is equal to what? Return on investment. And the return is what? 0.20. Now, what is B? B is what?
B is the earning retention rate.
Earning retention rate is in the formula. Check it. See, it's the earning retention rate. This is it. So the 40% of earnings is always retained based on this formula. So your growth rate will be what? Your growth rate will be what? 0.20 multiplied by what? 0.40. So you have it as what?
Just 0.08.
You have it
That's
as
8%.
0.08, which is same as what?
8%.
8%. Same as 8%. So we have this example. Let's take this example of class exercise. Be able to solve this. That is
So please, can you go back to the last slide now? Thank you. It's okay.
so we can have an example in this order. We can have an example and say Badmos PLC Admos PLC has 1 million ordinary shares. 1 million ordinary shares of 1 naira, each. The company has a policy. Company has a policy of retaining 25% of its earning. 5% of its earning, and normally achieve 20% return on investments. Question is, what is the company's growth rate? What is the company's growth rates? There is no any ambiguity in this. Everybody should be able to solve this. So what is the growth rate here? G is equal to RB. G is equal to what? R is what?
0.05.
Okay.
0.05. That's 5% growth rate.
We have it as 0.20 multiplied by 0.25. So the results will be what? 5%. 5% growth rate. 5% growth rate. Though based on the syllabus, we have to talk about risk. Let me skip risk so that I will not alter the flow. Yes, we have cost of preference share capital. Cost of preference share capital. What is preference share? Let me start with that. Preference share. What is preference share?
Can I try?
Very well, sir.
Preference shares, I would say in my own words, shares allotted to some individuals or institutions or investors at a premium price, which is usually lower than the ordinary price or ordinary shareholder. One advantage of the premium shares holders are they will be able to receive their own dividends before the ordinary shareholders or something like that. Correct me if I may be wrong.
All right, sir. Thank you very much. So preference shares is also known as preferred stock. Preferred stock. So they are shares of a company's stock with dividends that are paid out of the shareholders. They are paid out to the shareholders of these preference shares before ordinary share dividends are issued. So in the event of liquidation, the shareholders with preference share are settled from the company's asset before the ordinary shareholders. And one thing is that most preference shares have a fixed dividend. They have a fixed dividend. And also, the preference shareholders do not have any voting rights in the company. So preference share combines the features of debt and equity because it pays fixed dividend and has the potential to appreciate in price. So preference share could be cumulative or non-cumulative, and preference share could be participating and non-participating. Preference shares could be redeemable and what? And irredeemable preference shares. So when you talk about cost of preference shares, you can look at the cost of irredeemable preference shares. That is paying an annual dividend in perpetuity and having a current SD price of of PO can be calculated as follows. So for you to calculate the cost of preference share, the formula is your current dividend, divide by what? The current market price, excluding dividend. So this is a case where dividend is constant and there is no growth. It's a case where dividend is constant and there is no growth. So where we have dividend, where dividend is constant and there is no growth, we can look at an example. In some literatures, it can be D divided by market value multiplied by 100, as I've said. So where it is irredeemable, where it is redeemable, we apply the concept of internal rate of return. We're going to see when we move further in our explanation, we'll see the application of internal rate of return on issues of redeemable preference share, redeemable debentures. So looking at this example now, a company has an issue 1,006% preference share of 1 naira each with a market price of 40 kobo. What is the cost of preference share capital? What is the cost of preference share capital? The cost of preference share capital, if it is irredeemable, will be what? The dividend is what? The dividend will be what? The dividend will be what? 6% preference share of 1 naira each. It means the dividend can otherwise be referred to as the interest. So the interest in relation to this is what? The interest is what? It is, you said 6% preference.
Please, who can hear Mr. Tokwe? I can't hear him.
He has left.
I think network
He has
for
left.
him.
Is the class over?
I think he just joined.
Yes, I left to do something. I just joined again.
No, we're not talking about you. Mr. Tokwe left the class.
Okay.
Yeah, sorry, it's raining here, and I just lost connection. So the cost of preference share when it is irredeemable will be what? We'll pick another example to show this, to explain this further. So when you compute, the result will be what here? 6/4 like this, 10%. Let's pick another example to expatiate this further, because let's say a company has an issue. A company has an issue. A company has an issue. Preference has an issue. Preference share with a nominal value. It's a nominal value of 25 kobo. Nominal value of 25 kobo. The dividend is 5 kobo. It's 5 kobo per annum. 5 kobo per annum. What is the cost? What is the cost of preference share? What is the cost of preference share? What is the cost of preference share? Now, this is a case of irredeemable. Yes, I'm bringing this as an example under irredeemable preference share. Now, the formula is what? The formula is this. So based on this question now, what are the variables? The dividend is what?
Five kobo.
The dividend is 5 kobo. Kobo. The market value is on the
25 kobo.
Yeah, it's stated as nominal value. 25 kobo. When you multiply this by 100, you have what?
20%.
You have it as 20%. You have it as 20%. Now, when it is redeemable, okay, let's take it further. Let's see. So we can have a case of debt, irredeemable debt capital, irredeemable debt capital, irredeemable debt capital. So the cost of irredeemable loans, paying an annual interest in perpetuity and having a current market price will also be calculated in this manner. But in this case, in the case of debt, the issue of tax will set in. Tax will set in. So the cost of debt will be interest into the bracket of 1 minus t divided by market value of debt, excluding interest, multiplied by 100%. Where t is what? T is the rate of corporation tax. And I is what? The annual interest rate. And PO is S interest market price of the debt. S interest market price of the debt. Though I didn't, it's clearly defined here. It's clearly defined here anyway. So all these are not necessary. So now, looking at this example now, a company has an issue 5% irredeemable loan note, currently quoted at 105.5. 105.5 cum interest per 100 naira nominal. Assume a corporation tax of 30%. Calculate the cost of the venture. Calculate the costs of the venture. The interest is what? From the question, let me. What? 5%. Interest rates. The corporation tax is what?
30%.
The corporation is
30%.
30%. That's 1 minus 0.3. 1 minus 0.3. Irredeemable loan note currently quoted at 105.5 cum interest. What does this imply? It means what?
Inclusive of.
Inclusive of interest. So we need to
Yes.
Including.
We need to remove the value of interest. That is we need to remove the value of interest. Now, what is the interest? The nominal value is 100, right? That is the value at par. At par. Yes, at par. It's 100. So what is the interest on 100?
5.5.
The interest on 100 is what? 5% of 100 is what?
105.
Is equal to what? Percent multiplied by what? 100.
5.
That's 5.
That's 5.
5. So the market value is what?
105.5.
105. So what will be the S interest?
100.5.
Yes. That is excluding interest. And 5 minus to be equal to what?
100.5.
Of debt excluding interest here. Give us what? Will be what? 100.5. So when you simplify, you have what? The cost of debt will be what?
$3.48.
3.48%, right? Cost of debt 3.48%. Who's not getting it? Who's not getting 3.48%? So hope this is clear, please.
Yes, sir.
All right.